Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, November 7th, 2019. I'm going to keep this one limited to members because I want to cover things other than the broad market. Now, what I won't do here, I did a very long video earlier today, again, because I wanted to cover all those asset classes I've been highlighting recently, or at least most of them, and then I never got to crude, so we'll get to that today. I'll just say this: we did have a reversal today in the market. It's nothing huge, but a pretty decent reversal, especially when you look at the volume today. Most of the volume came after 240. We had a drop off in there. Might be attributed to something I saw in the headlines about China. I think somebody posted something in the trading room, or no, maybe I saw that on the Wall Street Journal. I get email alerts. Okay, neither here nor there. Let's just mention that TLT, gold, everything else did bounce from about those levels when I was doing the video earlier today. So here it is. So not much. A decent bounce, but again, it still closed down quite a bit. So a lot of work to be done. But again, the basis for that anybody interested, taking a shot there long at support. But longer term, I never really went into that. Longer term, when I look at the outlook for treasuries, this is a 30-year chart going back, a monthly chart going back all the way to the late 70s. And keep in mind that interest rates have been in what we call a secular bear market. These are cyclical bull and bear markets within the longer term secular bear. And things were, you had a real clean price channel here. I haven't covered this chart in a while. I used to update it quite a bit. And then what happened in 2008 is unnatural market forces, and that's my concern. A lot of other people with what the Fed's done. It's a grand experiment. Never ever done anything remotely close to this in the scale that the central banks have done. So what it's done is just it's distorted financial markets, and this is all this. These are these rounds of QE. Money printing, and so therefore it's kept rates artificially low for a while, and but you can see when you look at this chart again, monthly chart, big divergences building, and it's really not rocket science. Rates came near zero. Now this is the 30-year bond yield. I should have mentioned that right away, TYX, and that's not. We don't have negative rates yet in the U.S., although a lot of European countries do. But the floor is essentially zero. When I say essentially, yeah, you can go down, go slightly negative, but you're not going to go to -5, -10. People would move money right out of the bank. So again, zero is effectively the floor. And it's just a question of when does a new secular bull market and rates start, or do we just stay down here for the next several years, maybe a decade or more. But I just wanted to say in that, this chart just tells me over the long run, rates have for the most part nowhere but up to go. Again, that doesn't mean that they're going to go up right away. They could stay flat for a while. So, like I said, the point of all that is going back to TLT here. Just a bounce trade. TLT is just take a shot at support. For what will probably be a bounce trade here if it, if my outlook for the equity markets pans out here soon. So let's talk on that. Let's get to the equity markets today. And again, so you saw lift off gold, silver, everything else off those lows from when I did the video earlier today. And probably the biggest development today was, and I posted it under that last post on the comments section on the home page today. At the time I took a screenshot. QQQ had fallen and hit the trend line. So as I said yesterday, and I've been saying for a while, we need to break this. This is probably the more important trend lines out there right now. It's much better defined than the SPY 60-minute chart. By better defined, I mean we have a lot more reactions along that trend line, including yesterday's low, which bounce. So my thoughts on that, which I shared, is this thing is getting long in the tooth right now. Sorry, I had to pause the video there for a second. Anyways, so what I had said in there is my guess is that will probably be the last time, but like I always like to say, support is support until unless broken. But based on, again, how long this rally is getting in the tooth from the 60-minute chart, overbought, divergence is building, probably go some sooner than later, and my guess is maybe tomorrow on a gap down. And so to that, and it wasn't just QQQ, I also mentioned the trading room as well. that on that NQ 60-minute chart, which we're now looking at here. We also fell, if you recall in the video earlier today, if you caught it, I added this trend line right here, this yellow trend line, which I've just overlapped in blue, and we fell to that, plus there's that 8200 support right there. We hit both those levels at once, so my again, I said I expect at least another minor reaction, but I think it's minor. Somebody asked, "Hey, Randy, are you going long trading that?" I said, "No, not worth it. I don't think there's enough meat on the bone. Just probably better to wait for that to go." And my guess, it'll probably go tonight in the overnight session with a gap down, and then if so, either way, whether it goes today, tonight, tomorrow, next week, until you break that and the 8200 level. If and when you do, that's your sell signal there, and that would open a door to move down here to about the 8123-ish level. The line's at 8122.50, and then that would be first target there for NQ, and quite possibly more. Again, that's my minimum target there, and I think it would look something like this. Come on down here to that preferred target there, target zone about 80.40 to 80.50 or so. Okay, that other video earlier today just went so long trying to cover so many different asset classes I didn't get to crude, but I'll do that now, and I posted this again in the trading room shortly before the close today. So what we have here, remember, it's at 57.54 level. I've been highlighting that recently. We've had just numerous tails. We came very close, reverse there, hit it almost perfectly there. Tried to break it here. You can see that white part there. That's a candlestick shadow, or when it's above, you can call it a wick. Means that intraday they tried to break out. Inter-period, 60-minute chart right here, hourly candles right in there. And that means that candlestick couldn't print a close there, failed. We did get a close above it, but not very impulsive. And more importantly, like when you want to look for a breakout, ideally you don't want to see breakouts occur when conditions are overbought and you have negative divergence. So as I pointed out there, it basically just extended the divergence, and the fact that we broke above it but then failed again and failed impulsively, that's not a good sign. It's telling me that a lot of buyers are sitting there waiting at 57.54 barrel, and they're selling crude. I think Saudis obviously want crude up right now. They've been lobbying OPEC, the other OPEC members, to cut production so they can buoy their IPO. But it's market forces, and again, it's technicals. You can sit here all day long and say, well, okay, because Saudi Aramco IPO coming out, they're gonna bring oil up to whatever. I mean, maybe they do, but I rely much more on the technicals, and right now what I'm showing you here is this nice clean wedge pattern confirmed with negative divergences and multiple failures here around that 57.54-ish level. Oops, went away. And so my point was, or what I had said earlier, is that a break really below the trend line right there. You have minor support around 56.88. So if you break that trend line, your next support and first target is about 56.24. I know it might not look like much, but if you trade CL, that's put a few nice pennies in your pocket right there. Even that small move like that. And ultimately, the arrows that I had drawn, you probably just want to trail stops down. It could hold after that, but I could also easily see it working its way down here to this trend line. A lot like natural gas. You have an uptrend line down there that I said natural gas may work its way to. Now this is crude, of course, but again, it's a trend line that hasn't been visited in a while. And usually when you start to establish a pretty well watched trend line, prices get ahead of itself. You have a pretty good rally, they get away from the trend line, and then they revert back to the mean or back to the trend line. So that would be, point being, if you've been shorting here, if you're still short from the other day, there's been several ops there, shorting ops at 57.54. Your next objective short entry, if you want to add to it or just hold on, is break of that level, and then at that point maybe just trail stops down. And that way, if we reverse off 56.24 and that's all it is, you're going to get back a little profits, but it's still allowing you to stay in that trade, and that would be a nice swing trade. By the way, you have both price support around 54.75, a pretty decent support level too, as well as the uptrend line right there. So I think that's a pretty nice target for crude if we can get back down there, and then cover, maybe go reverse for a bounce, depending how the charts look. It's impossible to say if we even get there to begin with, and certainly impossible to say how the charts are going to look. What's the technical posture of the indicators? Are we oversold? Are we not oversold? Are there divergences, bullish divergences or not? So again, we'll keep an eye on this one. And of course, guys, if you don't trade futures, USO you can short, DWT you can purchase, go long. That's I think it's a 3-time leveraged short crude ETN. Okay, and just an update on NG. Like I said, there's some similarities on NG natural gas futures. There's a trend line again that we had quite a few reactions down here, and we haven't visited that trend line in a while. So should that natural gas short trade continue to pan out, we entered the gap today, couldn't make a full gap backfill, but again, we've been inching our way lower. There was that spike up after the inventory report, which was immediately faded, and you can see that this would be the final target on that NG, or I should say DGAS, a short trade, a backfill of the gap. And I might even, if there's time before we get there, may even extend that to this level. Well, you know what, let's just, for now, of course, unless I put a post out before the target's hit, that will remain the final target on DGAS. But I just wanted to mention that you could do the same thing. You could, if that level's hit, set a stop somewhat above to allow for a little reaction, or not. Sometimes you just go right through a resistance or support level and then hold out for a move down to that trend line. And that would be, here's what DGAS looks like. First target being hit today, made our way partially into the gap, pulled back a little bit, and again that would be DGAS. Of course is in reverse because it's an inverse short ETN. There's that comparable gap right there, and this probably the downtrend line's not the same. Remember, natural gas is trading virtually around the clock, 24/7. DGAS, what you're looking at here, are just regular session trades. So you're going to have different technicals, different trend lines, different reaction points. And but if you look at it this way, you have a price channel right there. So maybe a break out of that would give you a little bit more. And before I leave this one, I will say, the bounce could be over, so, don't let it get away from you. If you're in that and you have profits, at this point, raise them. That's where the official stop is, or was originally. But now that the first target's been hit, it would only make sense to raise stops to at least assure some kind of profit. And how tight you want to get, it's just up to you. The tighter the stop, the greater the chance you have being clipped out on just the gyrations if it's going to continue on up on DGAS, but a wider stop, of course, the flip side or the downside to that is the more profits you give back if stopped out. And I updated RTY in the video earlier today, but what I didn't show you is the IWM daily chart. It's been a little while, and a member Mike8124 had posted a chart of or IWM in the comment section below the last post. So yeah, that prompted me to update this. It's a level I've shared here before. I have it even color-coded blue. It's a very significant level, around 159.50 or so. Call it Mike 8124 has a level around 160, give or take again. And this is 2019 right here. Here's the start of the year. Every single attempt at that level, and this is, well, 4 failed so far, and just like what was I showing there, crude with that little pop sometimes, and this is typical, and this is what you almost have to anticipate in this market in this day and age due to the algos. Even back in the day before the algos, you had market makers who would love to do stop raids if they had the power to bring a stop up. In other words, when you see a well-watched resistance level, previous major reaction high like that, and of course you had levels, reactions all the way back here. That's why I have that line. On a scale of 1 to 10, that's close to a 10 for resistance on IWM. And again, it's where we traded all year. But my point was, if you're going to trade it, if you're going to use the MO, there's a couple MOs for trading a range, a price range or channel. You go long and then close your longs at the top of the channel, and or short a rally to the top of the channel. But you have to, again, because the algos know there's going to be a cluster of stops above there, and if they can push it up, clear you out, and then they go short with the shares that they shook out of you by making you cover. And so that's how you have to trade it. In other words, if let's just say every reaction stopped at exactly 159.41, you don't put your stop at 159.42. You give it a little bit of room. And so either way, we'll be watching this level. Obviously, the momentum to the market's the upside, but that's how it always is when there's a trend. I made some comments on the front page today to one of the members. It's recency bias. Obviously, the market always feels bullish. IWM feels like it's going to go up forever when it hits that level because it's been rallying for weeks. But this has just been the MO. It's been hitting that level, and like I like to say, until and unless resistance is taken out, that's what it is. So we'll watch that. It's a pretty big level. We had positive divergence down here on IWM, and we did take this trend line. I'm not giving as high a weighting. Why? Well, it's all about the number of reactions off there. The trend line started here, and we had a reaction here. Little bit of a reaction there, and that's a minimum. It takes, in my book, 3 reactions. So I put a much higher weighting on this level. So we'll watch that. Now, okay, so how to trade that if you want to trade IWM, well, obviously you can go long if you're bullish and you think it's going to break out and run, and just have a stop somewhere below this trend line. You can short 159.41, where we've been for you can see here the last 1, 2, 3, 4 days. We failed to get through that level, or barely above it right now. Actually, no, we closed back down right here at 158.67. Candle's green because it's showing we closed the day positive. That's how I set my candles to show me. But we closed at the bottom end of the range. So yet another rejection off there. So you either short on or around there, or I should say, a break of the trend line. And what does that mean, and/or? Well, you take a starter position there, short if and when the trend line breaks, especially a solid daily close. And how to trade it? Well, the MO has been so far, when you failed, you moved at least down here to this level, and 3 out of the 4 times you failed there so far this year, you moved to the bottom of the range, which is right here about 145. So you could just swing a stop down there. Then the thing about ranges is you don't stay there forever. This range is getting long in the tooth. It's either going to break to the upside or downside soon, I would imagine. But again, just sharing that with you, a level to watch. And make no mistake about it, the small caps are still, like a lot of other indexes, sectors especially. It's just really the large cap stocks. It's a handful of large cap stocks that are holding this market up. IWM and the mid caps as well, topped back here and way back in over a year ago. And looks like what is that, August of about the end of August 2018 or so, and they're still well below there. And you can see that level there. Here I have it at 161 or so, so same thing, and there's that price compression. So this is the market trying to decide which way to go, which way is the next move. And here was a trading range similar. You broke above that trading range back here, and that's how they work. So if I don't follow up on this again, your trading ops are, you have a trading range, you broke above it, that's a buy signal, you back tested, that was your next objective long entry on the back test of the channel, because it then becomes support. And then you had another buying opportunity there, and then you went on to new all-time highs, and then you had it again here, and there was a bounce trade, and that's a good bounce. We're looking at a weekly chart here, and then finally tap tap tap, it broke, and there was your sell signal to short because you broke that support level right there. So this right now, these are your levels to trade. If you break out above, then you could look to buy back tests on it if you get that, or you can short it here for a ride down to the bottom, and maybe even just if it gets there, just lower your stops and position for a break above, because if you get down there, you're getting closer to this primary bull market uptrend line on IWM right here. Where did it go? There we go. I don't have it off the lows in 2009. This is a better fit for me on IWM for the bull market trend lines. I have 2 of them right here. And finally, I want to show you one more thing, and we'll wrap this video up and keep it relatively short today. I keep talking about how this is the stock market has been lifted by just really a handful of mega cap stocks that continue to get inflows due to their heavy weightings. It's a vicious cycle. There's been just a massive, unprecedented trend towards index investing. People have given up on, for the most part, passive or active fund management, because most fund managers are not outperforming the indexes. So you're seeing, people are getting advised to just buy index funds, and they're doing that, but it's creating imbalances in the market because cash is flowing into the mega cap names. I'm going to give you an illustration here. What I have, this is a list of all the components of the S&P 500. There's 505 stocks in here. Some might be different share classes, whatever. It's roughly 500. And what I've done is sorted these by market market cap. So what we're going to start out, we're going to look at with the largest market cap. Again, these are the ones with the highest weighting. Yes, you know the names: Apple, Microsoft, Alphabet, Amazon, Facebook, JP Morgan. And I'm going to rifle through these. I'm going to move that off the screen. We're going to start with the largest, which is the 1.2 largest publicly traded company in the world right now, and that's Apple at $1.2 trillion. Heaviest weighting in the S&P, heaviest weighting in the NASDAQ 100. What you're going to see here is a common theme. All of these stocks in the top at or near all-time highs, and this is what the market looks like right here. So there is Apple, Microsoft, Alphabet, Amazon, right off on all-time highs, Facebook, JP Morgan, Visa, Johnson & Johnson, Walmart. The only one, energy, is down. I'm going to hit it because I'm going in order here. Now we're down to 309 billion. So ExxonMobil or even Walmart at 339, it's about a third of the weighting that you have on Apple and Microsoft. But Bank of America, so everyone so far other than ExxonMobil, because energy's in a bear market, is what's lifting the market. Now let's do this. Let's flip it around. Let's go to the smallest companies within the S&P 500. So I'm going to start here at this company here. MAC is a ticker at a $4 billion. You can see how many of these companies, they don't move the needle, but what it's showing you, I'm just using an illustration here to show you really what under the hood, what's going on in the stock market. So I'm going to go through these in order, starting with the smallest, and you can see here, this is a 10-year weekly chart. And this company, like many of these, this is early 2015 right here, and this stock has fallen since then 72%. That is beyond a bear market, and it's still, remember, they'll jettison out of the S&P 500 sooner or later. That's not going to meet the criteria, and I'm going to go through these real quick. And again, you're going to see a common theme. So AMG peaked back here. This one's down 67%. HP, that's not Hewlett Packard, that's Helmerich and Payne. XEC, okay, so you're getting the picture. LB, I mean, look at these are all components of the S&P 500. This is what most of the stocks in there are doing, or I should say, or at least a good part of them. And again, I'm just flipping in, I'm not skipping any, and just going and showing you what it's looking like. So you can see the effect again. And so what it is, fewer and fewer stocks continue to lift the market. And yes, if you're in your 401k is doing good, it doesn't really matter to you at that point. But where it's going to matter at some point, when the tide changes and there's net and money starts coming out of those, it's going to have an oversized effect, because we've never seen at any point in history, even the last bear market, we weren't this top heavy in those just a handful of market leading companies that make up the majority of the return. So anyways, you can do this yourself if you have TC 2000. All you have to do is when you pull an ETF like this, freestockcharts.com will do it as well. Click this little thing here. It gives you your related items right there, all the components of an ETF or a sector, and then go here, click fundamentals and capitalization. You add that column, and then you can sort it from there like that. All right, guys, we'll wrap it up here. And again, that's all long-term stuff. It's not going to matter. Those companies peaked years ago. They've been diverging, moving down. So it's not like, oh my gosh, wow, the market's going to crash now. No, the market's going to go up until it breaks technically, and it's that simple. I told you the trend line on SPY is not as important as the one on QQQ. And again, this is 60-minute charts. Even when that goes, it's not any kind of huge major sell signal, take everything out of stocks. But we'll see how far it goes. And again, the charts are what I call stacked. We have those negative divergences from the 60-minute time frame that I just showed you here on the daily time frame out to the weekly time frame right there, and even on the monthly time frames as well. And these are your big long-term trend lines, and covered these. So right now this is the S&P. It's above trend. In a strong, vigorous market, you get above trend line, you have these strong rallies. Lately we've been hugging the trend line. The market's been going up, but as I've talked about for almost 2 years now, we've had 5, including the most recent breakout to new all-time highs. 5 breakout to all-time highs, and I'm talking breakouts not when in other words, when you broke out the other day and then today's a new high. I'm not talking over this high. I'm talking distinct highs separated by a period of a couple months, and that is right here. So you had no, we need to go back farther. Right here, and I measured them out, and I've done this many times. So you had a major reaction high there in early 2018. This was your new all-time high. It was each and every one of these. That was above that one, this was above that one, this was above that one, and this was above that one. Those are distinct peaks. All of them were 2% or less, give or take 2%, not even 3, 2.1, whatever. And this one today, as of today, I measured it out, it was about 2%. Doesn't mean we can't go 3, 4, 5, 6. Doesn't mean we can't go up 10, 20% from here. But in my reply, to somebody on the front page about, hey, shouldn't we just be buying the trend? I said, no, to me, technical analysis is the whole crux of it. It's all about looking at past price action, similar technicals, volume patterns, all types of things in the market that have happened in the past. That's where all these chart patterns came out. People had discovered, head and shoulders, rising wedges, all these different patterns that what you do is you recognize, and if you see similarities, you scrub them with volume, and the more similarities you have, the more likely the market or a stock is to play out the same way. There are no guarantees. Unfortunately, there's not a single chart pattern or anything that's 100%. But trading is about putting the odds in your favor, and if that's been the pattern, wash, rinse, repeat. To me, is insanity is doing the same thing over and over again and expecting different results. And to me, so that's anyone who was bought any of the last breakouts in the last couple years, because you bought the breakout, you made no more than 2% each time, and you lost almost 25%, 10 or whatever it was, 8, 6 each time. And say, oh well, I'd stop out. Well, where are you going to stop out? What happens is most people will write it down and they end up stopping about here. You can't run a 1-2% stop loss on the SPY. You're going to get stopped out even in an uptrend on the daily, back and forth. So anyway, so like I said in there, there's a lot of similarities that I've discussed recently. Extreme bullish sentiment, extreme low volume, negative divergences, overbought conditions, everything you can see here, we're overbought right here on the RSI, and that's what I'm saying, that breakouts that occur with negative divergence and overbought conditions usually fail. And so that's why I think the chances of the next 10% being to the upside before the downside are very low based on this. Otherwise, there are some breakouts to new highs that look good, especially when you have a stock or an index that has consolidated for some period of time and built up some kind of a basing pattern, let's say something like this, and then worked off the overbought conditions, worked off the divergences, and then you get a breakout that is a sustained breakout. All right, we'll wrap it up here, and we'll keep an eye on those 60-minute trend lines. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.